Right. Hello, everyone. A very good afternoon to all of you. And thank you for joining all of us here with the FX Markets panel. Today's panel, we're going to be talking about evaluating the quality of Asia's FX liquidity amid the rise of EFX in a very compressed margin environment. So before we kick off, let me just let the panelists who are with very diverse background and experience to give a quick introduction. I'll start with myself. My name is Ping Tan. I run the electronic FX trading business in Bank of America, APAC. And then let me pass on to Kevin for the intro.
Thank you, Ping. Yeah, my name is Kevin C. I run the FX executions at Altus Capital.
Thank you, Kevin. Over to Waikin.
Thanks, Ping. Hi, everyone. My name is Waikin, and I take care of the BidFX regional business.
Thank you. And over to Quentin.
This is Quentin from LMAX. I'm looking after the institutional FX business for Asia.
Thank you. So maybe let's just kick off with Quentin then. From a platform provider point of view, and I know you have background before as well in the sell side as well, but where from your angle do you see the new breakthroughs and innovations since maybe from the onset of COVID-19?
So it's been obviously a very interesting few months and very unexpected to say the least. So we've seen a lot of changes in the FX dynamics recently, which actually has been driving a lot of innovation across different market segments. So especially in the buy side kind of franchise, we see a lot of clients who want to be less reliant on broker dealer kind of platform and have their own kind of execution stack. So we see a lot of investment in EFX tech. So they have full control on execution costs. So I think it's good in a way that they have like full control on of the LPs, which want to choose and be a bit more LP agnostic. So this is a trend we're seeing a bit more where they're definitely less reliant on FX broker or just broker dealer tech and have their own or use a vendor like maybe like Waikin. So that's a great kind of trend we're seeing. We see some electronification as well, obviously, like in the market, and maturity of client expectations. To me, are reflecting a very strong sophistication from retail clients and institutional clients. So we see like banks, non-bank, we see fintech players, we see FX brokers like competing for this kind of market share, and I think this is very healthy because it drives innovation. And things we've been doing like over the last few months, for instance, like on the back of customers' demand is, to give you a few examples, for instance, Weekend FX, like so FX trade 24 hours, 24/7. So now it's possible to do it using kind of crypto currency regulations. We looked after building a dark order book on the back of customers' demand as well the last few months, which has been very successful. We looked into things like being able to cope with negative prices because we know it's going to happen, especially on oil. So this kind of, always push us to drive innovation and think outside of the box. And I think overall workflow has become more complex. There's algo trading models are becoming more sophisticated, but the key trend I would say is really I think to spend on EFX tech and making sure that clients have ownership of a trading cost.
Thank you. That was a very good summary. I thought, and obviously through an angle to, what the platforms like, Waikin's on, and maybe Waikin, you want to put some comment on that angle?
Yeah, I mean, very fortunate to be able to help kind of align with the Singapore government's intention to build the FX ecosystem. And during my tenure at XTX Markets, we were very fortunate to be able to given the opportunity to be the first market maker that had installed a full stack of pricing and execution capabilities into SG1. And if we were to look at that from 2018 to now, that has massively grown. There are 11 formal nominated providers and inside that community, and I think it's still counting to about 17 to plus providers, except for Bank of America. And Sorry, I had to throw that one in.
We're just throwing angles, arrows at each other at the moment. It's going to come back to you. So Kevin is staying out of this at the moment.
So,
the try is always right.
no. So I really think that extrapolating from what Quentin has said, the call it the COVID pandemic and opportunities. All of us sitting here have had the fortune and the heavy-headedness and late night sleeps and blur between play, rest, and work, all skewed towards a market that's been pretty positive for us in terms of business, and hence the elements that we're involved in, including innovation, e-trading, consumers and clients like Kevin, who I believe are not only the benefactors of this, but has a wider array of different choices through what Quentin was saying about multiple providers and a larger community. When you attract that into Asia, whether it's just Singapore or the other growing regions, including, let's say, Australia, or what we hope will be a massive change in Hong Kong with the Greater Bay Area, I would call it, like a stimulus drive. What we'll have is potentially in the next few years an even bigger progression from what has occurred in the last few years in terms of progression and innovation. Going back to like SG1, which is an experience level that I think we all have been involved in. That was one entity, now grown to multiple, and I think it's going to be more. Does that really change everything? I think every center is trying to maintain their presence in their each way. Japan does it in a very conservative and quiet way. It's not like it's completely disappearing. Their corporate and domestic market is massive. You can't change that there. But SG1 or Singapore in particular is not an immediate region or city that's right next to the fortunes of China. So it has to do certain things in its methodology and plan a long game way ahead of everyone to make sure that there's survival and growth in whatever ecosystem that they build.
Yeah, I mean, it's interesting, and obviously you bring in the idea of the long game, and obviously we all know China is in the long game in the long run anyway, as with everything. But yeah, the SG1 initiative definitely, I think, would have literally accelerated the innovation and the amount of fintechs and ECNs that are being supported, right, on the back of not just FX spots, right? The MAS are supporting bonds and all that, which is definitely a very exciting opportunity. Obviously, me being Singaporean, I would just be supportive. But that said, I have to admit that, and I mentioned in another panel as well, that it is making definitely the whole FX or electronic FX landscape very much more complex as you think about more matching engines and where where should a client like Kevin go, like where do I point my matching, etc. So that is becoming quite an interesting challenge as we as we get more innovations and more disruptors in the area. I'm going to Kevin. What do you think from your buy side lens? I mean, how do you think this whole landscape has changed in the last few years? Obviously, maybe especially last year, 1 year must be very interesting for you as well as you cope with people working from home and the LPs all maybe working and calling you from home. How does that work for you and how has it been?
Yeah, absolutely. Our business wasn't that much of a disrupted by COVID as we very much completed our electronification many years back. So we were able to work from home and place orders. That wasn't an issue. But you're talking about a few years ago, we've seen this trend where we see the emergence of non-bank liquidity providers and the stronger, more sophisticated bank LPs just moving forward and leaving the rest behind. What I've learned in March during the COVID, right in the middle of the COVID breakout, was we had this liquidity crunch, and I feel from a buy side point of view, we really need more diversification. I think development of SG1 is a very positive one. because in March, what we saw was just everyone, using similar methods, quant methods to assess and tier clients, and they all pull out pretty much at the same time, and there was a vacuum in liquidity. And we were fortunate that we had a number of relationships, a good number of relationships, and when the so-called Tier 1 banks or liquidity providers pulled out, we did fine, because there were banks that we didn't trade with for the 18 to 24 months, and they suddenly stepped up and provided the liquidity that we needed desperately at the time. So yeah, I feel the diversification is very important, and I hope the space can diversify a bit more rather than getting a few dominant players, grabbing the whole market share.
Yes, I think all of us would like diversification in as many. But then again, I guess when you talk about the diversification, and obviously, like you mentioned, when you have liquidity crunch and your normal, say, top 5 LPs, whatever, that the whole construct might have changed. And you're obviously maybe blessed, luckily, like most people do, I guess, at least have 20 LPs today. And that whole diversification can create also, I guess, it helped you in those kind of challenges. And when markets come back to normal, how do you then decide? When do you constantly tweak that 5, the top 20 LPs, or do you go to 30, or do you decide somewhere in the middle is in the right medium for you to then decide? What are the top LPs? What metrics do you use to measure those LPs as we think about liquidity provision here for you?
We're a quant shop, so we use a lot of quant metrics to assess and rate our LPs, the markouts, and we like to use a rival price as a benchmark too, and also the markouts that platforms provide. We do our own markouts to identify who are recycling liquidity and who are not, and these are the metrics that we use. And I would say 20 LPs is probably on the high side. I would say 15 is probably the optimal, and where you probably want to trade with 5 to 8 in a normal liquidity conditions.
Yep. And
you probably want all of them available when there's a liquidity crunch. Which is why I think a multi broker platform, what Wycombe is selling is a great product.
Come on, Wycombe, do you want to have anything more to add? How many LPs do you have now? Let me guess. 30?
Okay. On that point, Bank of America is our favorite.
Of course it is.
LMAX is our best.
We're turning off the line a minute.
But truthfully speaking, I think you guys all know me from my old world, and this is new to me, and I'm learning every day. And when I'm sitting as a sell side guy, I'm thinking whatever I'm doing, it's the best. When I was in Morgan Stanley is the best, but it's not a flow bank, or it wasn't. When I began that business, and I was up here this hill trying to convince people like Kevin to give me a chance, when he's looking at me like, do you even have liquidity? Like, do you do FX? That was many years ago. And if I was still there, I would bet you anything that I would still go around thinking that Morgan Stanley is the best place. When I'm XTX markets, I'm thinking, wow, we're the most transparent organization. We do not do anything like the other banks do, or high frequency traders, and we don't recycle liquidity. We're just so smart. And when I'm sitting where I am now, I
on the dark side.
Yeah. I am everybody's bucket boy, which is really this is exactly the thing. This is karma. So when when I'm sitting here now on the dark side, as you say, I tend to understand where Kevin's coming from. So when I go to him wearing my XTX markets hat, I'll say, you only need 7, and you rotate that. and you have backup. It's obviously needed when the March spreads blow out, liquidity is thin, spreads are like ridiculous, and there's zero liquidity, and you think you need that arsenal. But in usual times, a few LPs satisfy most of your needs, and the more LPs you have, very fortunate that Kevin knows the whole game. Many people don't really look into TCA and analytics to actually think about things, and technology hasn't caught up to them, where you have both the actual usage of real data to accompany your intelligence in trading prior to hitting the market, during in-flight, and also post. And not many people can provide that in an intelligent way. And I guess that's also why we're a little bit above the other platforms, if you had to only give me one plug.
So going back to that, I guess it's not maybe more beyond the platform. I mean, from a platform conversation point of view, and when you see all these liquidity venues and sources coming in, how maybe from an LMAX point of view, how do you guys think about how the various sources are adding to the quality of liquidity that you provide to your end clients? Do you need more? Do you need less? Or where do you think we are today in terms of sources that's coming through to you to provide on?
Yeah, it's a very interesting question, right? Because this market kind of macro is changing to some extent. We see banks taking a bit less principal risk, we see more liquidity recycling. It's very hard to find true market maker who are actually adding liquidity. So how do you actually identify them is a pretty good question. But typical kind of differentiator, like when you look at platforms or even LPs, is it firm versus non-firm? Is it like what are your markouts pre-post trade? What's your cost of a reject? All these things kind of are taken into account to build an operative function, but then you optimize to decide where to trade. But even apart from that, I think a very important consideration is the quality of the data and the quality of matching. Because you may have like a similar liquidity from one platform to the next, but the way you distribute the data would be completely different. So we have more clients asking us what data sets do you provide, or what kind of, what are the rules of engagement, as opposed to what spreads you are showing. So it's kind of, evolving in that way. And, I'm a big, obviously, supporter of having kind of a transparent marketplace. So where it's kind of real-time market data, there is no randomization, there is no speed bump. And what you see is what you get, basically. And this is quite important when you talk about transparency, about reliability of a platform or a venue, is how it really operates and how do you share the data. So I think the TCA metrics and the objective function around it to come up with your prioritization is very important, but the way you consume the data and the way you enter the trade is very key too. So yeah, it's something to consider.
So it sounds like there's a lot of things to consider. So from Kevin's point of view on the buy side, when you have to look at which platform to choose, even with direct connectivity to various LPs, and then everybody providing you different types of data. Like I said, you already at your quant shop and do a lot of your analytics. So do you normally just literally take away, so ignore the so-called analytics from other places and just do your own clean data set when you analyze? Is that where you're coming from at the moment, like in terms of deriving what's the right place to, which is the right platform and the venue and the sources?
No, we do leverage markout data from LPs, the individual markout data. That's useful too, because we do a very high level analysis, whereas the broker markout data tend to be a lot more detailed, where they look at the trade level granularity. So I think that's definitely, that data adds value. Of course, then the platform will be able to provide a multi-dealer markout data, whereas our focus, our own analysis focus, will very much be on the P&L impact.
Right. Okay.
Yeah.
So in today's, time today where we talked about how complex the market structure could be, the amount of data, markout data they could potentially be getting from the providers and also the platforms, where do you think is missing, like from what's been provided to you? Do you think even as a platform, even as a buy-side recipient of all this data, do you think we need more data? What kind of metrics potentially is missing to make our jobs easier? Joaquin, should I start from you? I know you're selling your MIS analytics now to me and to everyone else.
I've exhausted my plugs. I really would like, it's really weird because when people go and pitch things, and I'm probably the world's worst salesperson, you go there and you say, oh, AI, big data, all these things as quantitative analytics. And actually, you go to a proper trader, and a lot of you guys have been in that place, doesn't mean anything to them. Because a lot of the stuff it doesn't align to what they do on a day-to-day basis. And by the time it actually has any fruit, it's too complicated to actually hit into what they're doing at a day-to-day level for making money. And I find that kind of ridiculous. You're saying you're so damn good, but where are you in terms of market share, or how's your liquidity during this moment in time? And as an example, what I would like to see is where people's talk is aligned to them actually helping someone when it comes to whatever you say in terms of a pitch. It actually helps them make a decision in trading immediately. And that can be in a form as a simple algo or a simple staging of an order, to as complicated as getting every bank's or non-bank's algo provision in one place. I think there still needs to be an evolution there. There are still a lot of traders out there, minus out Kevin, because he's always been, in my opinion, electronified, digitized, that are very, very old school. They just still trade on that 10, 20, market inputs day in, day out. They move their frog this way and they put their coffee cup like that way. And, at home, it's probably
there's a feng shui element as well. Don't touch the dragon.
Yeah, it's just like, stop looking at that chart. It does you no service. You should be looking at another chart. So, okay, I'm not disrespecting anyone that makes money that way. I'm just saying that there must be a better way, with everybody saying how good they are with tech and how that aligns to someone's bottom line. Yeah,
I think you bring a very interesting angle in, right? Besides the principal risk price, we definitely see a lot more interest in the algos, and in times when you're seeking liquidity in a liquidity crunch scenario, how best to leverage, the algo side of the business as well, which is quite interesting. Like you said, some traders are used to the way they're doing things versus having to let the algo, deal with some of the complexity as the market move around. And those are the metrics that can be quite interesting.
I also find. Sorry to interrupt. Just a very, very, very quick interruption. It's just I also find it very, very interesting how some customers are not willing to give even a simple taste of technology a go, because they're so aligned to just doing business the old way through a Bloomberg chat or over the phone. That kind of surprises me, even though you can prove to them very quickly that they'll save money and not lose on situations where they're open to a risk and a lack of liquidity.
Yeah, and I'm hoping, and we definitely see more electronification because of COVID. Like, people are working from home now. They realize they can't get hold of their brokers. They can't get hold of the usual guy, the banks that they talk to. And you're definitely using more electronic trading, I see, from our angle. But I think, like you said, people are very quick to go back to the old ways. But yeah, it'd be interesting to see how, I think as you think about innovation and as we can look at the algo products as its own, even it's quite, like you mentioned, it's so many data points. How do you benchmark what is a good provider? But if you can put all of them together, like say on a platform, which, you can most likely find ways to properly assess them and give it a shot. What do you think? Kevin, I know you guys have your own execution style as well in terms of how you want to do your algo staging, etc. Do you think from the liquidity seeking point of view, you would leverage a platform to use this kind of algos, or is it more like you already built your own set of algos and you're happy with your metrics you've got to find the liquidity you need?
We are a consumer of algos, but not necessarily in FX as an asset class. Yeah, I just feel, just personally, FX and algo is a weird combination, because in FX the liquidity quality very much depends on the LP. So whether we slice it, time it, and any other way, if ultimately the liquidity provider provides the algo to you, so you're not able to diversify, and they warehouse all the risk, then how you differentiate the quality is ultimately down to the person who runs the manages risk behind it, and not how you slice it and time it and all that. We've experimented with a lot of bank algos, and yeah, I think it probably adds some value when the market is volatile. There is probably some internalization going on. But for us, where we trade a lot of emerging market currencies, and we tend to trade it when the market is quiet, I think that was a lot of value add.
Okay. I guess also with the emerging currencies, you would also argue they're less solid venues. I mean, with the G10, you most likely, which is maybe over fragmented, like, that 20 venues or platform sources you can go to, and they all look pretty much the same, to be honest, besides the primary. But EMs, maybe you have to be, maybe hopefully one day when we have more, like SG1, providers in that space, that would be more interesting. So going back, I guess we've got 2-3 minutes left before we end this panel. How do you think, I guess from your point of view, we've talked about the algos, we talked about the landscape of the liquidity and the challenges we face in COVID. What do you think looking forward are the challenges that this whole landscape will look like in the next 5 years? Quentin, should we kick off with you?
Yeah, sure, no problem. So, and we talked about, going back to what we're saying, I think it's going down to identify what actually matters to the end clients, what metrics to use, how can we improve their execution by providing simple kind of analytics. It could be as simple as what is the price improvement you're gaining on the platform, how much latency you gained by tweaking these parameters, and what kind of LP to use, because some are recycling our liquidity, some are not. And I'm sure Ping, you have models to identify which LPs are using liquidity or not. But I think there's going to be more LPs. I do believe there are going to be more LPs going in the market and coming up especially from the crypto space, on which we're seeing very active. But at the same time, maybe less venues for price discovery. So there is likely to be consolidation for where to find your true market data that makes sense for the models, market data which is firm, market data which is fast and reliable, but maybe more kind of bilateral relationship, more LPs who could tap on it on the back of it. So it's going to be interesting kind of, dynamics over the next few years, where I want to see consolidation in market data kind of primary venues, but more LPs to offer value.
Okay, good point. How about you, Waikin?
I'm going to be a little bit provocative and say,
as you always are.
And I hope I'm wrong, by the way. So I have a feeling that there'll be so in terms of market fragmentation, I don't disagree with what Quentin's saying. I just believe that not only would there be a consolidation of providers, there will be new ones. But I think what would be very, very interesting is that we may move away from just this primary source of liquidity. So what I'm hoping to occur, whether it's SG1, which I very much hope and will be a part of, fingers crossed, a holy grail, is to have another venue source where there is elements of peer-to-peer matching, proper peer-to-peer matching, where discrete, anonymous, semi-disclosed, fully disclosed matching can occur between someone like Kevin and another party, not deliberately disenfranchising someone like Bank of America, but just opening up the opportunity to do matching at a next generation level. and not just using the word next generation. I'm thinking about peer-to-peer. I'm thinking about peer-to-peer liquidity, and credit, because credit's also a backdrop that a lot of people forget about when we talk about all this stuff in front of us. If there was a lot of credit, and if companies like yourself continue to support the credit model, which obviously you do, it's a lot easier for everyone to come to play at the institutional level. But when it isn't, that's where the problem occurs. And you have prime, you have all sorts of potential, I don't want to say problems, just different fragmentation elements, including sub-levels of recycling liquidity and whatever it is, good and bad. So that's one thing I think would be very interesting. I also think what Quentin was saying about the element of multiple products and asset classes, I think the merging of that and the ability to have the evolution of certain currencies, whether it was renminbi onshore now to a very CNH heavy and specific allotment, and maybe the merging of or reliance on not just the OTC market, but maybe the listed and other venues, including crypto. That could be very interesting into the future, whatever that becomes.
Yeah, I think that's maybe one of the key things for SG1, right? Hopefully with SGX and the NDFs, that it could create, the marketplace for OTC and futures. But going back to your point about how, the credit was a good angle, I guess, from even for us looking at our PB business. It is such an important, expensive commodity as well, right? You got to get it right, which is kind of what we saw in SMB, right? The Suez crisis, and making sure that we are pricing the right quality for the credit we want to give out. And going back to the angle around how when we then end up having to peer-to-peer matching, which obviously should drive down costs, and we honestly kind of do it today, right? Like if you look at all the volumes going through, right, 6.6 trillion, whatever, the bulk of it, if you look at it during the March period, I guess, bulk of the obviously interbank volumes has gone up, right? Because most people are aggressing and we cannot internalize because the market's just moving 3% away from you. And so a lot of that liquidity actually ended up being matched on the interbank versus prior to a volatility situation, most of us are internalizing 80, 70, 85% of it. So in that case, we're already matching with our peer. I wouldn't say peer-to-peer, but I think there's this ecosystem that allows matching and internalization. But yeah, you're right. At some point, but however, in the event, I think when you have the edge of one-off tail event like SMB crisis, when you have the peer-to-peer matching, I think I'm very cognizant of the fact that when a client comes to me and they want to adjust the rate, they would refer to their primary venue, which most likely was, at the point in time, was EBS on Euroswiss. They don't care where they match with all the different LPs. And that's a point where I think it would be quite interesting to see if and when SG1 is a success, it'd be interesting to see who can be the true, primary venue, venue for the clients to rely on when in crisis like that. Because EBS is not going to be there anymore, right? EBS is going from 3 matching engine to 2 and will not be. Most likely is going to pull out Tokyo, and most likely will not be in Sync SG1. Yeah. Right. With that, I'm going to give a very quick poll amongst the 4 of us, I guess, before I end this. Right. Do you think it's a yes or no answer? Do you think we'll end up with more fragmentation in EFX in 5 years' time? Right. Kevin, what do you think?
Yes.
Okay. Wykin?
I hope not. I hope to be a
yes or no answer. Yes or no answer.
Yeah. Well, can you give me a time span at least?
Maybe. 5 years. In 5 years' time, when you look back, in 5 years, looking ahead.
In 5 years, specific to the currency pairs we're looking at, I'm hoping it's going to be either the same or a little bit better. If you're looking at real.
So yes or no?
Fragmentation. I'll give it a little no, just to be provocative.
Quentin, what do you think?
All right, I would say a bit more LPs, but less venue to trade on down the line. So yeah, it's a bit like a little yes.
So it's a yes. Okay, so 3 years and a little no. Thank you for being provocative. Thank you very much to the panelists, and thank you FX Markets for hosting the session. Thank you, guys.
By the way, this is not recorded, is it?
We don't know. We should know by now the US president who's out. Thank you.
Thank you, everyone. Have a great afternoon.
Thank you.
Yes.
Bye.
Bye.
Recognized for the ability to execute and significantly improve EFX trading, the award winner this year is Citi. Best FX Options House. The award winner was recognized as the dealer that provided the highest quality liquidity and pricing in FX options. And the winner is Citi. Best Retail FX Platform. To win this award, you need to provide the best customer service, abundant information, and fair trading. The winner this year is IG Asia.